earnings were expected at 85,000, and they came back much higher than expected at 172,000. And to put that into perspective, the 85,000 that was expected, it came back at 172,000. 172,000. Not only was this a 4 sigma beat to the median estimate, but it was also above the highest estimate of 125,000. So it's absolutely huge beat. The total change in non-farm payroll employment for March was revised up by 29,000 as well, from 185,000 to 214,000. And the change from April was revised up from 64,000, from 115,000 to 179,000. With these revisions, employment in March and April combined is 93,000 higher than previously reported. What does that mean? Well, it means that the Federal Reserve has absolutely nothing, no backstop at this point to not fight inflation. They have no labor worries. There's no worries about the labor market in the current moment. And so if there is no average hourly earnings increase, which there wasn't, and that would have been some kind of backstop for the Federal Reserve to, at least pause and not sound hawkish. All the inflation data is increasing, and the labor market is stable and actually strengthening, and no inflation. You're right, or no average hourly earnings, increase, but the CPI and ISM prints, all of the freight data that we're starting to get out here. In fact, there was a report earlier this week, freight data, that was expecting a 253% increase in logistics costs moving forward. So there's a problem here moving into the future. The Federal Reserve, when it is a demand side inflation increase, they have a tool to combat that, right? And that's the old 1980s, 1970s, 1980s playbook. Raise interest rates. But interest rates are already high right now. Interest rates are already high. They don't have any room. They were at zero in 2022, and they had room to raise them. This is not a demand type of inflation. This is a supply side inflation increase. And the Federal Reserve is, for the most part, on the sidelines. But to maintain their credibility, they're going to have to at least be perceived as fighting inflation. And this is where, or why we've seen this sharp decline as we go into the morning. The rate hike probabilities went from pricing in a March 2027 rate hike to all the way pulled into December. And you can see how close the 43.3 is to this 39.8. And we are not very far away from pulling this rate hike another month into the future, which means that we've gone from, at one point, this stream continues at emoneyaddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.